Welcome to the Michael Yardney podcast. Today's session is a question and answer day. In other words, you, our listeners, have chosen the topics. And I'm joined by Ken Race, Director of Metropole Wealth Advisory. And we're going to discuss three of your questions: how to help your children into property. And even if you don't have children yet, I think you're going to benefit from some of the pearls of wisdom Ken drops. We're going to answer Claire's question about how to stop your children squandering their inheritance. And Ken is going to explain what happens to your superannuation when you die. Now, a morbid thought, but something you've got to plan for. So, a wide range of topics. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Today, I'm joined by Ken Race, Director of Metropole Wealth Advisory, to answer a number of your property questions. Now, Ken's widely regarded as Australia's leading property tax and structuring expert, and he's the co-author of the latest edition of What Every Property Investor Needs to Know About Finance, Tax and the Law. Maybe we'll have a little bit of a chat about that in my talk with him, because if you're a property investor and you want to learn how to structure yourself correctly, not only are these questions we're going to help you with today beneficial, but you'll probably get some benefit from our new fully updated book, What Every Property Investor Needs to Know About Finance, Tax and the Law. Hi, Ken.
Hi, Michael. Hi, listeners.
Now, we regularly get a whole lot of questions left on Property Update or on our social media about all sorts of matters related to property and tax. So I've selected a number today that I believe are going to be right down your alley. So let's start with one sent in by Don. I think it's a common question that people are thinking about in our sort of age group, but I guess other investors who are younger and who've got parents who are a bit wealthy are probably thinking as well. Anyway, this is what his question was. Ken, we're in a fortunate position to have paid off our home. We've got a number of investment properties, but now our children are having difficulty getting into the property market, in part because it's hard for them to find a sufficient deposit to buy the type of home they're wanting. What's the best way of helping our children into property? I know that a number of clients have been asking you that as well, Ken.
Yeah, it's coming up more and more, particularly as the ability to borrow is getting harder and harder. Particularly, it's the deposit that's affecting more people. So there's a number of different strategies that we find people go through. Let's maybe look at them one at a time. But before all that, let's premise it with the issue is tax. And I hate to use that three-letter word, but tax should be part of the consideration, where I normally say never do anything just for tax. But if you're going to pass on assets before your death, there's going to be capital gains tax, there's going to be stamp duty. So you've got to be very careful. And both the ATO and the state governments say that if you're going to transfer something, it's got to be at market value.
Okay, so maybe I should do the usual disclaimer. There's always one right at the end of the show, but even though you're an expert in these areas, this is not personal advice because we don't know people's personal circumstances. But at the end, if some of this piques your attention and you'd like to know what it means for you personally, then I'm sure, Ken, you'd be happy to answer people's questions face-to-face or over Zoom, not in a public forum like this.
That's become almost the default face-to-face now, Zoom. We just
That's
yeah,
right.
Absolutely.
So sorry to interrupt your train of thought, but I think you were initially pointing to one of the ways you could help is actually just gifting or giving a property.
Yeah. Both the ATO and the state government put a deemed value of the market rate, at the market value. So you can't transfer it at zero and expect to pay minimal capital gains tax or stamp duty. So it's called market substitution rules. It's what is the market value, irrespective of what you've done. So we've got to look at other strategies. And like Don says, it'd be great to be able to help our kids pre-death, but we've got to manage those taxes. So three things normally are happening with a lot of my clients at the moment, and when I talk to the general populace, these things always crop up. It's how can I help my children get into that first home? So it's either investment property or a home. So let's look at the home in the first instance. And as the deposit is almost the hardest thing for the young couple or the young person to get, it's helping them with that deposit. And yes, you can either give them the money, and if you do that, it becomes their money. So if anything happens to them, if their relationship with their partner breaks down, all that goes into the pool for the family law court to distribute. So a lot of our clients are, can I say, loaning money to their children. And when I say a loan, it is a proper loan with proper documentation. It can still be interest-free, payable on demand, so you don't have to do annual accounting and tax returns. But you've got to be careful that those documents are correctly set up and the annual compliance is put in place.
What do you mean by that?
Yeah. And at least if it's a loan, then if something happens, you at least get back that principal. And like a bank, the bank, when it gets its principal, doesn't get the capital growth on the property, but at least that initial amount is preserved. So you've got to talk to your broker. This is something I think you can't just do directly with a bank. You've got to go to a strategic broker because they can I say, put it in such a way to the bank where the bank won't then say that now means you've got 100% loan, because they would take the loan from the bank, the loan from the parents, and say you got 100% loan. Another way, of course, is for parents to guarantee. And that might help with, if they don't have quite enough of the deposit, there would normally be the lender's mortgage insurance. That's a good couple of percent. So on $1 million loan, that can be $20,000, $25,000. So if a parent co-guarantees the loan, then maybe the LMI, loan lender's mortgage insurance, isn't applied. But again, be very careful, because 4 times out of 5, 9 times out of 10, a very large number, the bank will ask the parent to guarantee 100% of the loan. So if something goes wrong, you're up for 100%. Convince the bank that you'll guarantee just the gap of what's needed. So if it's an extra 200,000, you'll guarantee 200,000.
And I guess, Ken, in 3, 4, 5 years' time, when the property's gone up in value, the parents could remove the guarantee when there's more equity in the system.
Correct. The child refinances, gets below that figure. So as long as the serviceability is there, which would have been required in the first instance.
So one way of helping your kids in the market is giving a gift of a deposit or helping them with the deposit, because the serviceability is an issue, but the deposit in the short term is a bigger issue. I know some people think, oh, look, my child's not 18 yet, but rather than buying an investment property, another one in my name, maybe I should buy it in my child's name, a minor. Does that work?
Look, the answer is yes, but there's a lot of porcupine spikes on that one. Children under 18 who hasn't physically worked for the money are taxed at a very punitive tax rate, 66% on a sliding scale down to 45, plus Medicare levy. That means the rent, if it's going to be positively geared, the child will pay tax at that very punitive rate. And then you've got to consider, if it's negatively geared, you won't get the tax deduction. But you actually can still buy in the child's name if they're under 18, because hopefully you as the parent are the guardian, the legal personal representative. As long as you buy correctly, identifying the child at the beginning, putting the right documentation in place, the titles can change at some later stage without triggering the capital gains tax and stamp duty, which if you bought in your name and you transferred to the child would have those taxes.
That seems a little bit complicated. Is there a better way?
A lot of our clients sort of, can I say, want their cake and eat it too?
Don't we all?
So in those first 2 examples, the gift, you just got to be careful there, whether you're buying the property in the minor's names. There's lots of issues there. Do I get the capital gains tax? who pays for it, at what tax rate, and on the rental income, the tax rate for the minor. So that's why a lot of people consider the use of a trust. Because in that scenario, the trust owns the property, not the child. So the property is bought in the trust, and the one that is probably used for this type of circumstances would be what they call a family trust. So you buy the trust, you set up the trust, you buy the property, you get your finance, and then the rent goes into the trust. It's then distributed, and you probably wouldn't distribute it to your 5-year-old at 66%. You'd give it to an adult, even if they're at 45 cents. In the trust, you do get the 50% capital gains tax discount if it's ever sold. And again, you distribute to the appropriate family members.
Now, clearly this makes sense if it's an investment, but some people would be saying, hey, but I actually want to live in that. Now, I don't want to let out all your secrets, but I know we spoke over the last couple of weeks about two of our clients who ended up, for their own personal reasons, needing to own properties in trusts and somehow or other still managed to get some of the great benefits of the principal place of residence.
Yep. So there is this incorrect belief that the property has to be in the name of an individual. That's not true. It can be in the name of the trust, and with the correct paperwork,
to get the principal place of residence tax exemption.
And that just literally means that for the period of time that you're using and occupying the property as your home, the capital gain is tax-free.
So this is something that the average accountant doesn't know. And I know I just said a moment ago that there was a couple of clients who dealt with this for various reasons. It just suited them to do it this way, personal reasons. It's not what would generally recommend to buy a principal place of residence there. But if it's a good reason, if it's a genuine reason and documented correctly, so that's something that if somebody's interested in, again, this is by no means advice. We'll leave a link in the show notes, or go to Metropole and go to the Wealth Advisory tab and have a chat with Ken if you wonder whether this would be something that would suit you or maybe your children.
Yeah. And look, the same can be said if the parent had originally bought a property in a trust as an investment and later on wants the child to use it as a home, then again, that documentation, but in reverse, can be put in place to give the child the benefits of those free capital gains tax. But it's very technical, specific advice. And I think, as you were interluding or said, Michael, this is not something that, can I say, the local accountant understands or knows about.
It's not something that's regularly done, but that's why Wealth Advisory are specialists in this area, and then your accountings in the long term. So I guess the first question, thank you, Don, is that how can we help our kids into property? It's the dream of, I guess, almost every parent, and I know you've helped and we've helped our kids, but you've got to set things up right and get the right question is also an interesting one. Ken, it came from Claire, who said, we have a son and daughter. We're both in our 70s and we've got some investment properties. We're afraid our daughter might sell when she inherits it. What can we include in our will so that she's going to continue earning rental income? They also Claire mentioned something about testamentary trusts. So I think this is a question wonder about, I don't want it to go to the wrong side of the family. I don't want my child to squander it. I've spent so long. What would your answer to Claire be, Ken?
Great question, Claire. And that question in different guises is coming up more and more, particularly as we see the divorce rates that we're seeing in modern society. We're seeing people in their second or third marriages. So people are very concerned that the assets that they've worked hard all their life to build go to the people that they wanted it to go to.
That's interesting, Ken. Only last week I was looking up something, doing some research, and I found the latest statistics in Australia suggest that 50% of first marriages now divorce. I don't know what the percentage is for second and subsequent ones. I know in the past it's been even higher than first marriages, but that's something we don't want to hear as parents, you and me. But on the other hand, it's a fact of life, so I guess you've got to prepare for it.
You've got to prepare for it, and you've got to plan for it. Hope it doesn't happen. So I think having a will is critical if you've built up assets and you're wanting them to be directed to the right people. And surprisingly, 70 odd percent of people don't have a will. Only about 30% of people do. And then that creates a lot of issues. So the traditional will says, when I die, it goes to my spouse, it then goes to my children. And that creates 4 potential problems. The assets go to a person. That means if they ever get sued, if they ever get divorced, that means those assets are available. You can't do tax planning because all the money is going to one person. And you can't distribute money to young children, as we heard just a little while ago, because their tax rate is 66%. So if you don't want one or more of those problems, you have to introduce a trust as part of your will. It just so happens to be called a testamentary trust, that you provide for it in your will, but it's not actually set up until you die. So there's no annual compliance costs. So we've got to then decide who will get your assets. And a lawyer many, many years ago taught me this game. And I say this with due respect. It's called kill the relatives. and it's without actually doing it. Please don't do it. But what that means is think of who the next person is going to be. So you give assets to person number 1, and when they pass away, it's going to go to person number 2.
That's interesting.
Have a thought of who that second or third person's going to be.
Mm-hmm.
And if it's not what you want, or if it's something you care about, then you just have to make sure that you put in the appropriate wills. So one of the biggest issues I see with people with a trust in a will, they still create a trust that has an end date. So trusts normally end after 80 years. So for an intergenerational wealth transfer, we don't want this inbuilt hand grenade to go off, because if those properties have done half as well as you'd hoped, in 80 years, the capital gains will be huge. And if it's property, stamp duty. So pass on the assets either individually to people via the testamentary trust, or if you've got multiple children, put all the assets into one testamentary trust to then be divided. And there's pluses and minuses for both of those.
Now, Claire asked Ken about the concept of, well, I don't want my money squandered. Is there a way of not allowing them to sell the asset and just get benefit from the distributions, or maybe for a period of time till they reach a particular age?
Absolutely. And you can do that in both types of will. And you can put restrictions on the sale of assets to an age. Or what I tell people is, don't ever say never sell, because, someone might need a medical procedure, a heart transplant or something. So you want to restrict those never sells for personal gains. So you don't want your kids to go and sell your investment property to buy a Ferrari, but obviously for a medical reason. So you can put those different triggers in place, and you can actually start saying, I want the income to go to those people, but I want to preserve the capital for the future generation. So maybe income goes to your child, but the capital then goes to your grandchildren, for argument's sake. So you can do all those sorts of things. That's why I say play that game of who the money's going to go to and where it goes to next.
So a lot of thought has to go into estate planning. It's definitely got to be more than just a normal will. Definitely got to be more than the sort of will you can get online. In the old days, you used to be able to get it in the newsagent. I don't know if you still do that. Remember they used to sell will kits?
Yeah, you can still do those will kits.
Yeah. So why would they come to you and the team at Metropole Wealth Advisory? Why not to their solicitor or their accountant, Ken?
Good question. I think it boils down to you're wanting a more holistic approach to your problems and questions. You don't want to go to a particular profession that is going to just look up the barrel of one thing. Yes, you might have a will, but how does it affect the asset protection? How does it affect this? How does it affect that? Yes, the accountant might give you a good tax opinion, but does it protect the assets in a divorce? So I think more and more we need a holistic approach where we look at multidisciplines. So going to somebody who understands those multidisciplines allows you to do two things. It allows you to ask the right questions, but critically, it becomes the conduit for talking to that other profession, someone to bridge that gap so that, we're speaking the right language, so to speak. And if you're getting the proverbial smokes and mirrors back, you need somebody to be able to identify that smokes and mirrors, that's not right. You haven't thought of 1, 2, 3, 4.
So that's something that you and your team at Metropole Wealth Advisory specialise in, and I'll leave a link in the show notes. So that doesn't mean that you're going to become their accountant or their legal advisors in the long term, but you're the, the go-between with some really big picture advice that helps everyone work as a team.
That's right. I mean, there was somebody many decades ago who said it's keeping the buggers honest.
So, yes, those people listening to this are going to be too old to remember the politician Don Chip in South Australia who said that. Now, we've got one last question to cover, and it's really about what happens to your superannuation when you die. And Ron left a question about that, but maybe I can just give some context that as for you and me and most people listening to this, they're probably going to end up, we hope they're going to end up with a property portfolio. But for many Australians, most Australians, their superannuation is going to be after their home, probably their biggest asset. And for many of them, it's going to be in an industry fund, or some unfortunately mess it up moving from job to job and have a couple of industry funds. For others, it's going to be a SMSF, where your team helps people put together a self-managed super fund to control their future. What happens when you die?
Look, that brings the first conundrum, if that's the right word, into the picture. Super is not your money. As much as we say, what are you talking about? You can't just go out and take the money out of your superannuation account. So you've got to put in place documentations, requests to direct the trustee of the super fund to do whatever it is you want with those funds. And can I say the standard answer is what they call a binding death nomination? So when I die, I want 100% to go to my surviving spouse, or 50% to them and 50% equally to the children. It's whatever you want. But in those industry or retail funds, that needs to be updated every 3 years. And if you don't, it becomes a non-binding. That means the trustees of those super funds have some input to maybe do something differently. So look up what you've got. The other issue then is for people who have got a larger super balance, then you've got to be more careful, because on the death of one spouse, it may not be allowed to be fully transferred to the surviving spouse, because they've got maximum caps. 1.7 million at the moment. That goes up with inflation over time. So you need something more robust to say how much is going to go directly to a surviving spouse and how much will come out if that's what you want. And sometimes people do what's called a superannuation will to actually manage that.
Well, I know that you and the team at Metropole Wealth Advisory set that up for Pam and me. And in fact, when you looked at my self-managed super fund, even though I've got an accountant and it's been audited every year by accountants as it needs to be, there were still some gaps. I wasn't driving it with all 8 cylinders, only 6. And so therefore having a superannuation checkup, in my mind, well, it was definitely worth it for me, and I'd be recommending it to anybody listening to this. If you've got an SMSF, go to Metropole Wealth Advisory, and I'll leave a link in the show notes, and get Ken to have a look at your self-managed super fund. Ken, what are the tax consequences of super when you die?
Yep. So traditionally, you can distribute to your spouse, a child, someone who's financially dependent or interdependent with you. tax-free. But the ATO takes a hard view of children. And what they
in
say
all sorts of ways.
in all sorts of ways. And basically, it's they have this notion of a tax dependent. And they say if a child is over 18, they can't be a tax dependent. And therefore, if they receive the money, then you pay tax at 15%. And if it's life insurance, because don't forget your super is not just your members' balance that you might see, it's any life cover that you have. So that could be a very large payment. And the tax on a life cover payment is 30%. So a third of it, by the time you take Medicare into account, can be wiped out if it goes to an adult child, and 18 if they're studying full time, up to 25 years of age. So you need to be careful if you're going to distribute different assets to different people to maybe do it the most tax effective way. Maybe to a spouse, you look at super. And again, as we said at the beginning, this is not specific advice because I don't know your circumstances, but it could be the super goes to a spouse and maybe some of the other assets go to the children, because it's the super that's taxed differently. And for most people, unfortunately, if they die before pension age, then it's got to be paid out. And when it gets paid out, it has to be liquidated. So all the shares you own or all the properties you own or whatever has to be sold and the money paid out. And that creates all sorts of problems.
May not be a good time to do it.
Correct. And you have to pay the 10% capital gains tax. So again, there's different ways to distribute your super to avoid that capital gains tax and to maybe give you time to decide what to do.
Well, I guess what's happened is you haven't really answered Ronald's question because you can't, because there are so many options. I think the important note is that your super isn't automatically included in your will because it's not your asset. And unless you give certain instructions to your super fund trustee, it may not end up where you want it to be. If you're thinking about estate planning, you need more than a will, and why not have a chat with Ken and his team at Metropole Wealth Advisory? There's one other thing I'd like to finish off with, Ken, and that's about the fully updated version of what every property investor needs to know about finance, tax and the law. And in that book, which I'll leave a link to in the show notes, and by the time this goes live, the book will be available in good bookstores, online at financialfluency.com.au, or just in Kindle. There's where a lot of people now download their books. But there's a big new section, some big new sections in it, and you've made a lot of commentary about estate planning in this. So the sort of things we started to talk about, again, it's not the substitute for specific advice, but it gives people a good idea of the sort of things they need to think about and the sort of questions they need to ask.
That's right. And it's, I learned a long time ago, it's understanding what questions to ask. That's more important than the answer, because you can find somebody to give you the answer if you know the question.
Good point. So I guess I'd like to suggest that what every property investor needs to know about finance, tax and the law is what I'd like to think is a plain English guide, because some people do know how to use the system effectively, efficiently, legally. So this is a book for you. If you're wanting to work less, earn more, pay less tax legally, become financially independent. So whether you're a beginning investor or experienced, what every property investor needs to know about finance, tax and the law will put you ahead of the pack. Go to the link in the show notes. That'll probably be the easiest way. You can find it in good bookstores or on Kindle. And Ken, I know we both put a lot of time into that. Thank you for your collaboration in it.
No, thank you very much. And I hope readers get some good value out of it. I'm sure
they will. And we'll be back again in a month. So if you've got some questions along these lines for Ken, just leave them at Property Update, or you can email michael@metropole.com.au and we'd love to answer your questions. Thanks for your time, Ken.
Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to teach you about the most important of all the rich habits. Now, you've probably read my book, Rich Habits, Poor Habits, I hope you have, that I wrote with Tom Corley. That's become an international bestseller and translated into quite a number of different languages. But Tom did his own 5-year Rich Habits study, and he also studied a lot of research others have done on the habits of successful people. And Tom found that according to the study conducted by the economists at the University of Padova in Italy, individuals who read for self-education earned 21% more as adults than those who didn't have that growth habit. He also cited another study conducted by Daniel Belsky at Duke University, who studied 918 New Zealanders, and he found that individuals who developed the reading to learn habit earned more income, had more assets, and had better finances by the age of 38 than their peers. Now, as I said, Tom did a 5-year study on the daily habits of the rich, and he found that 86% of the rich loved reading, compared to only about a quarter of the poor. Tom found that 63% of the rich listened to audio books during their commute to work, as opposed to 5% of the poor. Now, this study was done a while ago, before podcasts were popular, so I bet you'd be able to swap that over for podcasts nowadays. Tom and his Rich Habits study found that 85% of the rich read 2 or more self-improvement books every month, compared to 15% of the poor. And Tom also found that 88% of the rich read 30 minutes or more each day. It was a daily habit compared to 2% of the poor. And when you find out what the average person reads, they read for entertainment rather than education. So the conclusion from this is parents who instill in their children the habit of daily educational reading, they then set it up for their children to earn more during their lifetimes. This habit, it turns out, follows them into their adult lives, even if you have to instill all these habits as kids. That's where we learn all the habits. Interestingly, a recent study by Brown University, in which nearly 50,000 families were surveyed, concluded that habits of children are unlikely to vary much after the age of 9. So it's not too late for you. You can work on your habits, but if you're a parent or a grandparent, these messages that I give in my Mindset Message are important not just for you, but for your family as well. You see, most of the early years for children, they're spent at home, and the bulk of the habits children adopt, such as learning to read, they come primarily from the parents. You are your child's mentor. As infants and toddlers, our brains are hardwired by nature for monkey see, monkey do behaviours, thanks to something called mirror neurons. So as a result, children pick up the vast majority of their habits from their parents, good or bad. So you can still develop this most important habit, the habit of reading for education, reading to learn, but why not instill it in your kids as well, if you're at that stage of your life where you've still got kids who are paying attention and listening to you. My kids are all older now, so they don't pay that much attention to me anymore, but I hope I instilled some good habits in them too. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?